My warm greetings to everyone joining us today for our webinar, Retail and HNI Investors in the Indian Bond Market, Decoding the Growth Potential. The webinar is organized jointly by Cbonds, global financial data provider with a special focus on bonds, and Debt Circle, research platform specializing in the Indian fixed income market. We were also firmly supported by our colleagues from Neo Group. My name is Maxim, and I am Deputy Head Emerging Markets Fixed Income at Cbonds. And for the next hour or so, I will be your moderator. As for the little introduction to our today's topic, I think it would be rightful to say that now the Indian bond market is experiencing a two-way movement when it is becoming easier both to issue debt securities through streamlined regulations and to invest due to decreased issue ticket size and the development of online bond platforms. As for the market volume growth, the question of the investment structure and finding new growth reserves is becoming more and more pressing. With estimated 7% of retail participation, retail share in total bond investments, the size of untapped potential in the retail segment remains really huge. And growing opportunities for high net worth individuals and opportunities for their direct participation is also a notable change to be factored in by the market participants. Today, in a company of our distinguished experts, we will try to walk the full path from the macro and regulatory context to the specific issues of liquidity, shifting issuance patterns, and investors' behavior, along with many more issues. Certainly, along this path, apart from numerous opportunities, plentiful challenges are lurking as well. That is why we decided also to address the issue of how the tools provided by our platforms can be instrumental for retail and HNI investors to overcome these challenges. Now, let me introduce our speakers. Vijendra Varankar is head and chief editor at Debt Circle.
Hello.
Yes, hi Vijendra. Nikhil Jite is managing director and head of fixed income at Neo Wealth and Asset Management.
Good afternoon, everyone.
And last but not least, Ksenia Dmitrieva is international business developer at Cbonds.
Hello, everyone. Pleasure to be here today.
So we will have each speaker's presentation first, and then we will come to the discussion part. So please don't hesitate to put your questions in the chat, and we, with the speakers, will do our best to address them. So let's get to the point. I invite Nikhil to open our discussion with his presentation.
Good afternoon, everyone. Thank you for giving me this platform. It's such a pleasure to be on this platform. I head fixed income for Neo Group. Neo Group is a wealth and asset management company managing assets above 60,000 crores. I'll be talking about macroeconomic policies today about India and how it will impact the retail investors and what would be the impact of this particular thing on global economy. Before coming to that, let me explain what exactly Monetary Policy Committee is and what impact does it have on the retail investors. Monetary Policy Committee typically is a committee which is basically a central bank, and the most important work for them is to balance growth and inflation in India and globally. In India and globally, after COVID, you have seen that inflation had risen, and because of that, lots of these central banks had to come and start increasing rates. Right from June 2022, you must have seen the rates going up from 4% to 2.5% to 6.5% in this particular span to 6.5%. It is a 2.5% rise overall. And in June 2024, RBI started with a withdrawal of accommodation, and they directly did not raise the rates. After that, it kept on, there was a prolonged pause from March 2023 and April 2023 onwards till almost Feb 2025. Uh, because since the inflation was very high during COVID period, lots of the lots of after COVID, there was a steep rise in inflation, and inflation for a lot of countries went above 7%, 8%. Similar case happened in India, and because of which RBI started hiking rates, and from 4% of repo rate, they went up to 6.5%, which is almost 2.5% rise in interest rate, because of which the bond markets had seen a significant rise in yields. But any cycle cannot stay for a very long time. So because of which after June 2024, they started changing their stance, and they were gradually giving a commentary of probably changing their stance to neutral in coming months, which they did in December 2024. Though the repo rate was around 6.5%, but RBI started, giving their views that the rate is going to be coming down. And after that, in Feb 2025 policy, they started cutting down the rates. Now, what is the impact of cutting down the rate in on the overall economy and the retail investors? Basically, investors can enjoy lower interest rates when they go to borrow from banks or any NBFCs. And overall, for the economy, if the rates are lower, it will boost the economic cycle, and there will be a pretty decent boost for the economic growth. India's GDP was seeing some moderation in let's say October quarter. It had fallen down to around 5.6%. But since the RBI's move of Feb 2025 of reducing the rate was actually predominantly because of that, and they started reducing the rate, which actually had started given a boost to economy. They are basically creating demand in the system, and as you can see in April 2025 policy, the rates fallen down to 6.6%, and in latest policy, which is in June, the rate was reduced to 5.5%. It was a surprising move of 50 bips of rate cut. It was predominantly done to boost growth in the economic system, and RBI has been pretty able to do it with a balanced act. The inflation currently is somewhere around 2.5%, and it is a pretty stable condition for India currently. And overall, if you can see on the graph, the GSEC yield and liquidity has decent impact on the decisions that RBI take. So as the policy rates come down, GSEC yields and overall corporate bond yields also move down, and it is predominantly driven by the liquidity that is provided in the system. On As you can see on the left side of the graph, these bar charts in the blue can show that liquidity, surplus in the system was pretty high during COVID period. Then gradually RBI started reducing the liquidity in the system because they were on the rate hiking cycle. At that point of time, liquidity was not easily available in the system, because of which the demand was reduced in the system, and the retail investor were not demanding a lot of credit during that period. But RBI very actively managed this particular liquidity, which is in the range of 2 lakhs to positive to 2 lakh negative, and this has clearly has impacted the GSEC yield, and GSEC yield has fallen down. Initially it went up, but it fallen down from 2023-2024 segment, and currently right from the highest point of 7.40, it has fallen down to 6.30. And as you can see on the right side of the graph, the 10-year GSEC benchmark has this is basically an indication where your country is borrowing. So the spread between the repo rate and 10-year GSEC has narrowed significantly. This is predominantly because of the liquidity in the system, foreign domestic inflows in GSECs, and the stance that RBI changed, which they changed from initially from withdrawal of accommodation to neutral and then accommodative again. And currently it is at neutral. In the latest policy, they changed the stance to neutral. So overall, because of a lot of demand in the system, the 10-year has seen so much, narrowing in the spread with the repo rate. Lot of retail investors have started investing into 10-year GSEC and other GSEC instruments. And this is the data that you can see specifically. Lots of regulatory changes have come in last few years. But before I come to that, let me talk about how the public issuances have risen in last few years, and how is the corporate debt market has deepened in last few years. So basically, during COVID, before COVID, there was a pretty. So basically, public issuance can do 10,000 face value, and private placements initially had at least 1 lakh of face value or 10 lakh of face value for each bond. But currently it is changed to 10,000, of which I will talk about in some time. But during 2012 to 2018 period, there was a lot of demand of public issuances in the economy by retail investors or other investors, because they were actually getting good opportunities to invest into corporate bond markets. Around 25 to 30 issuers used to come to market and borrow from public issuances, and they used to take public money through these issuances. But that number was restricted to around 25 to 30 names. But post COVID, after 2020 to 23, the pink line that you can see on the graph, it indicates that the issuer has increased to 40 to 45 currently, though the amount is around 20,000 crores, but the number of issuance says have increased significantly, and a lot of these NBFCs, NBFCs basically play a very important role in this public issuances. 90% of the NCDs are done by public, 90% of the public issuances are done by NBFCs. So almost 40 to 45 NBFCs have come to public markets and started issuing through public issuances. Apart from that, overall volume of debt market has significantly increased, and also the private placement, as you can see on the right hand side of your screen, has increased significantly, and it's a number that is increasing on a yearly basis. Overall volume that you can see in corporate debt market is about 17 to 18 lakh crores, and the private placements that have happened is somewhere around 8 lakh 40,000 crores. This shows that how India's bond market has increased in last few years. Now let me talk about how RBI and regulators have been working very closely, and they are trying to actually increase the depth of Indian bond market, and they're trying to make retail participants participate in all these issuances very actively. So in November 2021, they came up with a retail platform, which is called RBI NDS platform, Negotiated Dealing System platform. It is basically a platform wherein all the retail investors with a 10,000 rupees amount can buy G6 directly with RBI. And it was a historic move. Before that, there was no direct access for these individuals, maybe retail or HNI investors, to buy these G6 directly. So what this RBI's move was pretty, taken well by consumers and retail investors. After that, in Jan 2022, RBI actually asked all the primary dealers to provide pricings to all the retail investors, so that they can create this market, and they can, the retail investors can liquidate their investments into market. After that, there were a lot of online bond platforms that were available for retail investors, but they were not regulated by any of the regulators. In 2022, SEBI came up with an OBPP bond platform regulatory framework, in which all the bond platforms were asked to only sell retail listed and secured bonds on their platforms. On this platform, investors can actually buy bonds directly, right from 10,000 rupees to 1 lakh, 2 lakh, or maybe crore ticket sizes. This particular platforms are very effectively regulated by SEBI, and all the data or all the trades that have been reported on this platform will have to go to SEBI. So SEBI is basically promoting investors. They're trying to protect the retail investors by doing these regulatory changes. Uh, and then another historic move came in Jan 2023, where they actually reduced the ticket size to 10,000 rupees. And any that is in private placement. So any issuer coming into private placement now can keep a ticket size of 10,000. So each bond can be sold to the retail investors. Around May 2023, there was a lot of popularity of this particular retail platform of RBI that was seeing around 110% of the growth was there right from the uh, introduction of that particular web platform. Now, in April and May 2024, RBI actually came up with a mobile application. Initially, it was a web application, but after that, RBI came up with a mobile application of NDS platform. Now, investors on their mobile can buy G-Secs directly, G-Secs, T-bills, and SDLs as well. After that, in July 2024, they actually put some restriction of on 14 to 30-year bonds, so that FPI can actually buy very limited number of these bonds, so that retail investors are protected. So whenever retail these FPI investors, they actually buy or they actually sell, the pricing doesn't move up much. This they have done to just protect investors. Apart from that, they actually in July 2025 they came up with a launch of Bond Central, in which basically any retail investor can actually see the rating of the bonds. They can actually see the liquidity of the bonds. What exactly the prices are of the bonds. Each and every detail of these bonds will be provided by these SEBI and OBPPs. So this actually makes investors actually quite they can basically understand from market that exactly what are they buying, what are they selling, and there is a lot of transparency that is available for these investors. As I was mentioning, this particular platform, Retail Direct app by RBI, is becoming very popular. There have been almost more than 4 lakh registration that have happened. Overall, almost 3 lakh investors have opened their accounts. And the primary market, whenever GSEC primary market auction happens, the significant rise in primary bidding has happened from these retail investors. So right from 4,500, initially on the first year it was 2,000 crores. The subscription from these retail investors was around 2,000 crores. It increased to 4,000 crores in the next year, and currently it is about 6,000 crores. And the secondary market volume has also seen significant increase, which is currently about 4,000 crores. So any retail investor actually can buy and sell bonds on this particular platform. And overall, how all these things are actually impacting a wealth management firm, or or a retail investor who actually wants to go and actually have a wealth management system in his particular portfolio. So this basically helps in all these reforms actually help in create liquidity in the system. The most important investment, most important point when any investor actually is actually buying some bonds, he is actually worried of liquidity. So these platforms are actually making the liquidity possible for these investors. And actually these corporate bonds and GSECs offer a pretty decent return to their portfolios. They don't actually have to go to equities to equity markets to earn about 8 to 10% sort of returns. They can very easily with a safe instrument can buy their bonds on these platforms. And they can also get a lot of diversification in their portfolios through investing into different bonds. They can actually prioritize their investments by investing into AAA, AA plus sort of bonds. And a lot of these platforms and these regulatory changes are actually educating investors in increasing their increasing actually the asset classes in their portfolios. So this is about how the bond market has seen the overall impact of these regulatory changes. I think that's it from my side.
Thanks a lot, Nikhil. You covered the macro and regulatory side really comprehensively, and I have like a lot of questions in my mind, but let's wait for the discussion part with that. And now I invite Ksenia for her presentation of Cbonds tool.
I'm very pleased to be a part of today's discussion on the Indian bond market because, like, as an international business developer at Cbonds, a global provider of financial market data, we and I specifically help different types of investors make complex bond data accessible. So today I'll be walking you through how our platform can help both HNI and retail investors make informed decision with the use cases focused specifically on the Indian fixed income space. So we already covered, I would say, very precisely why India and why now. So India's bond market is undergoing a significant transformation, as Max already mentioned, and Nikhil as well. So, and once dominated almost entirely by institutional investors, it's now opening up to broader participation. So also recent policy support, improved transparency and public issuances by major corporates like Adani Enterprises, for example, are creating the conditions for, let's say, more inclusive access. So this evolving landscape makes timely, accurate bond data more essential than ever. So, and that's where the platform like Cbonds and that circle come in. Now, let me just briefly explain what we do, how we operate. So at Cbonds, we bring structure and clarity to global financial markets as a trusted data provider, having clients like all over the globe. Our main expertise lies in the fixed income market. So as you can see, we cover almost 1 million bonds right now with the full coverage, with the entire coverage for Eurobond universe. Nevertheless, our platform also delivers comprehensive data on equities, ETFs, mutual funds, and indices. So, and specifically for India, our coverage includes all government and municipal debt. We also cover over 26,000 corporate bonds in Indian rupiah and more than 9,000 issuing entities. So we offer quotes from exchanges and also market participants, as well as credit ratings from Indian local agencies, rating agencies like CRISIL, for example, and of course international ones such as Moody's, Fitch, and S&P, which let's say makes our platform a single powerful source for investors across the spectrum. So let me also provide you with a brief background regarding the main audience. So we have built a diverse global client base that includes audience starting from the large banks and asset management teams and to private investors and retail investors specifically. So today we work with over 1,000 institutional clients all over the globe and reflecting like the adaptability of the platform, because as you can see, anyone can benefit from the features that we provide. Locations, yes. So as I mentioned, we have clients from over 100 countries. For your information, we have the legal entity located in the UAE, in Dubai, and in November we will also host a conference there, because we also, apart from being a financial data provider, we also operate as a conference house. So and we also be having a conference in November, so feel free to come to this event, which is a great, let's say, opportunity to expand your network and find some interesting insights. Let's get back again to the platform to support your ongoing market activities. Cbonds delivers many tools designed to provide timely market information. So as you can see right now on the screen, we have a multifunctional screening tools for different assets where you can efficiently filter and find bonds, so stocks, ETFs, and mutual funds according to your criteria. And today we will showcase how you can make it for Indian market. Also, watch list to track your selected assets, including bonds, stocks, and indices as well, where you can also adjust customized alerts and notifications. Mobile application to have access to this watch list on the go. Of course, we also have Excel add-in. This is the plugin which you can install in your Excel and make different charts there and customize up to your needs. And also API and data feed solutions to integrate high quality bond data into your internal systems, into your platforms, applications, and so on. So now that you're familiar with the key tools, let's dive into a practical example using our bond screener. So this is the tool which especially can be used by Indian investors looking to quickly filter through thousands of bonds based on criteria like country, for example. So we will specify India here. Let's also try Indian rupiah to look for local bonds here. And we will also pick the minimum settlement amount up to 1,000 because the first scenario will be dedicated to retail investors who are looking for not risky bonds. So as you can see, I have also chosen max rating from Indian rating agencies from AA- to AAA. And here are the results that I got. So here you can get the general information about the amount, the price, the coupon, let's say also the yielded pricing, and so on. And then you can also export this table in a very convenient way in, let's say, not let's say, just like in Excel file, where you can also customize it, where you can add your comments and so on. So this is like the first scenario how you could use it. Now let's say that we are looking for bonds, again, in Indian bonds, in Indian rupiah, but let's say that are in circulation on a particular stock exchange. So for example, Bombay Stock Exchange. So we have different segments covered here in Cbonds. So, and let's just leave the same face value up to 1,000, and we will also exclude convertible issues as we're like a retail investor. So we found lots of results. Let's also maybe add yield, starting from some high yield points like from 4, for example. And now we got like almost 200 results. So we can work with these, again, issues. You can download them. You can, let's say, make different spreadsheets and examine these bonds. But I would also suggest you trying the feature to visualize these, let's say, the bonds that we got in table mode on a chart, because we are visual people, and it's like, you know, it really alleviates your workflow when you can see the information in a visual way. So we presented these issues on the chart. We can also add a benchmark, which could be, in our case, again, related to India, zero coupon bonds. So now we can see the differences between what we got and this crucial benchmark. Now, let's go to the issue page where we store this comprehensive data that we collect from the primary sources. So I have chosen 2 issues for you today. Both are with the high coupon rate. So this one is ECL finance bonds, as you can see, and for it we have prospectus. We have the largest database for prospectuses in the world. And I will also show you the chart. The price dynamics are presented here right now. So we can spot a significant increase of price, which is also very interesting to see here and analyze. And yes, we provide prices based on intraday basis and also end of the day prices. So as you can see there. Then all the crucial information about the issuance is presented here, including the cash flow, including the placement parameters, identifiers, also if the bond is taxable or not, then ratings with the historical data on them. So this one, I can see that there is like a negative, let's say, focus, but it was stable. So I can again analyze and make my, let's say, own conclusions about this particular bond and ensure whether it is, let's say, it is worth to invest in it. The second issue will be presented by Tamil Nadu Generation and Distribution Corporation bonds. So here you can see again the block with the major information about it, the status, the amount. Again, prospectus is available here, which we also collected from the primary sources. The trading chart, end of the day prices as well, which you can also use for your, let's say, evaluations. Issue information with the volume, with the face value, with the listing, and the cash flow itself, so that you could see when is the next coupon, what is the, let's say, coupon payment amount, and what are the early redemption terms in case there are any. So all of the crucial information is stated here for you as a retail investor or HNI. It doesn't matter. This information is really crucial, especially when it is located on one page. You don't need to switch, let's say, between two or more different pages. So, and of course, watch list. I usually call it, let's say, a personal radar system where you can add your bonds and then, let's say, monitor them. So I created a separate Indian portfolio with some issues here, which you can see. I have inserted the purchase price, the purchase date, just to see the delta between the price that when I bought this bond and the current value. And I can see also the dynamics of, let's say, the yield of the price, again, depending on, let's say, daily basis. So everything is presented here. You can also turn on notifications about crucial events, for example, coupon payments to be notified about them. News about changes in rating in issue ratings. It's also very crucial. Defaults, of course, so you will not miss all these important events. And of course, you can also track stocks here just to make it, let's say, as a complex tool, and indices as well, in case you'd like to track some macroeconomic indicators or some Indian indices. So I will stop my presentation here. So with India's bond market growing at a remarkable pace, now it is a great time to explore its potential. So I really appreciate your attention today. And to get started, you can simply scan any of these QR codes. We can be connected in LinkedIn. You can start a direct chat with me in WhatsApp, and I will be really happy to know more about your situation. What bonds are you looking for? And so I will also activate a 7-day free trial for you so that you can also see how our platform can meet your current requirements in terms of bond data. So we're waiting for your requests. So Max, I'm passing the floor to you.
And with that, I pass the floor to Vijendra.
Good afternoon, everyone. Welcome again to today's webinar hosted by Cbonds and Debt Circle. I'm Vijendra, Chief Editor of Debt Circle, and it's a pleasure to take you through the ongoing transformation in India's bond landscape. Over the next few slides, we'll cover what's driving retail interest, regulatory reforms, and why this is, great time for every investor to explore the opportunities beyond traditional avenues like FD and equities. I think Nikhil has already explained about the liquidity part. It was very well explained. I will try to summarize the topic now. Let's start by understanding, what is liquidity means in the bond market. So for bonds, liquidity is nothing but, in simple words, liquidity means how easily you can sell your bonds in the market without losing much on your pricing. So in India, as mentioned by Nikhil earlier, government securities, well known as G-Secs, they stand out for their liquidity. They come up with a sovereign guarantee and trade activity. So you can usually cash out with minimum loss in value. On the other hand, corporate bonds, however, don't have the same backing, and their liquidity depends on factors like the company's credit worthiness or bond maturity or interest rate fluctuation. So assessing liquidity is crucial before investing in the bonds, as it determines how easily you can exit from your investments. let's take a closer look. Bond as a liquid asset. Again, same point. G-Secs are almost like cash equivalents. So it's very easy to buy and sell with transparent pricing and a lot of daily trading activity. You can easily buy and sell government bonds. That's why many large investors in India favor government bonds. Um, and at the same time, corporate bonds in India are a different story. While they are listed on stock exchanges like BSE and NSE, trading volumes are still limited, and pricing sometimes is not transparent. As mentioned earlier, also liquidity for corporate bonds are varies greatly, mainly depending on issuers' reputations and bond ratings, and of course, maturity. This means that while some corporate bonds can be sold quickly, and other might need a bit more time or could be subject to price negotiation. Now let's talk more about corporate bond liquidity. So I think Nikhil has already mentioned about some reforms, right? So there are reforms in the corporate bond market, and also there is a technology improvement also, and that it has started shifting to the landscape, making corporate bonds much more accessible for individuals. For instance, the growth in online bond platforms, they have bridged the gaps by offering transparent pricing and streamlining the process for buying and selling. The another changes we see that many reputed companies and NBFCs they're attracting a larger and more diverse participation. If you look at the stats given by RBI recently, the average daily corporate bond turnover rose to around 7,600 crore in FY25 from like around 5,700 crore the last year. So that definitely shows there is some increase in trading bond volume, and there is a definitely there's an increase in the participation. However, it's important to note that most transactions are still led by institutions as compared to retail. But after SEBI's decision to reduce the minimum investment from 1 lakh to 10,000, retail participation has increased, and also it's a definitely is a clear sign of an opportunity for individual investors. Let's go ahead and just to understand what are the factors are basically affecting liquidity, corporate bond liquidity. I think at this point I already mentioned, so basically what really influence whether corporate bonds can be sold easily in the market. So first of all, credit rating is crucial. Investment grade bonds like triple A to triple B bonds are more likely to trade really well in the market, with triple A and double A bonds are being most liquid. Second, the size of the bond issue is another key driver. Largely and widely held issues trade more often, and at the same time, the smaller and private placement have low liquidity. So the other factor, basically the bond size, we should be taking care, and that is one of the factors upping the corporate bond liquidity. Uh, Thirdly, the maturity matters, basically 10 years. The short-term bonds, which are basically less than 5 years or less than 5 years, they're usually more liquid and they're really attractive for retail investor. Long-term bonds, basically more than 6 years, that tend to see more interest from institutions who are basically happy to hold them till maturity. The another factor is listing status of bonds. So compared to unlisted bonds, which can be harder to find buyers, listed bonds are benefited from regular trading activity, transparent pricing, and smoother exit process for investors. And finally, ongoing reforms like electronic platforms, they are making it easier for investor to find buyers and sellers, although there is still room for improvement like equity, and hopefully in near future with the help of SEBI and regulators, we'll definitely see there are a lot of changes will going to happen. The final topic, about, I will say again, I'll go back, and while basically for the investor, how you can assess your corporate bond liquidity for informed decisions. So there are, again, as I mentioned earlier, there are some factors. You have to assess those factors only. As I mentioned earlier, the listing status or trading volume. So let's just go through for the trading volume and frequency. So in short, there's not every bond in the market is easily liquid or equally liquid. So how can you investor make informed decision? So you look at your trading volumes and frequency on exchanges like NSE and BSE. So both the trade are liquidity basically much easier to exit from where you need to. So you have to take care what are the trading volume and what is the frequency of getting those bonds traded in the stock exchanges. Then another aspect you can watch out for, that is bid ask spread. It means there's a difference between the buyer offers and seller ask. That is another clue basically to assess your corporate bonds. Narrow spread basically shows the high liquidity, and if there's a wide one, it basically harder to sell quickly. Other things to quickly check basically credit rating. Higher is better for liquidity. Uh, Issuer size, they are basically more widely traded. Maturity is again 10-year, shorter is safer, more liquid for retail investor. So by prioritizing these aspects, you can manage your exit risk and avoid being stuck with hard to sell your bond holdings. uh, if I go further and just to just summarize what Nikhil has mentioned about different initiatives has been taken by SEBIs. So basically, in 2020, retail direct scheme was launched, giving individuals direct and seamless online access to government securities. The following year, 2021, it was stricter disclosure and transparency norms were put in place, ensuring that all the information like pricing, interest rates, and rising credit ratings was made available to investor. In 2022, that was the year it streamlined the trading platforms. So that was the year saw focus on making the buying and selling of bonds on recognized stock exchanges easier and less dependent on middlemen, rather intermediaries. In 2023, new guidelines require detailed disclosures on bond pricing, yields, and maturity terms. So investor can easily make informed decisions, and it's uh, whether he'll be more confident to take any decision about the investment. So basically, it's clear, these reforms are laying the foundation for wider and safer retail participation in the bond market. And if you go ahead and if you look at the 2024, uh, that was the year. Basically, it was a landmark year for retail bond investor. SEBI dropped the minimum ticket size from privately placed corporate bonds to just rupees 10,000, opening the door for new class of investor, which were basically previously priced out. SEBI also tightened the framework for online bond platform, insisting on safety, transparency, and grievance redressal, making it more secure for digital investors. Particularly, the innovative proposal was the liquidity window. That will definitely allow retail investors to sell their bond back to issuers before maturity, and this directly addresses the lock-in risk basically that was everyone is worried about. And finally, the point here was about a higher taxation on unlisted bonds, and certain debentures is shifting demand towards the listed bonds, and it was because listed is regulated bonds, so that will help to further deepen the bond market. So because of all these regulation reforms done by SEBI, there was a shift in the investment pattern of retail investors. So basically, let's wrap up the big picture. It's a lower entry barriers, growing digital access, improved regulations, and better transparency are fueling a surge in the bond buying. Microeconomics trends like RBI recent rate cut. So beautifully explained by Nikhil. Basically he has shown the trend of repo rate cuts from last 1 year. So there was a rate cut and cooling inflation, and that have made fixed income product again attractive due to higher return as compared to other products. Uh, Attractive yield AAA rated bonds now often returns almost like 30 to 50 basis points above top fixed deposit. Also, with double and triple B bonds are giving better and better returns as compared to other products. Of course, there is a more yield with calibrated risk. This the innovative online platforms regulated by SEBI are there, making it is easier for everyone. Like everyone is like from newbies to experienced investor, in terms of research, compare, and invest from from their mobile phones. Also, like together, these trends basically the reshaping the investment landscape and making bonds a very essential part of modern retail portfolios. So thanks to regulators, thanks to all the the people involved in the industry to make this they make these changes very essential for the retail investors. So let's now, how can Debt Circle will help you in this. So let's turn to Debt Circle. Let me briefly introduce a Debt Circle. So Debt Circle is basically a dedicated platform. It's only for Indian debt market, where we cover news about bonds, loans, and securitization. We just talk about Indian debt market. We are not covering any other products. So if you go further, our complete focus on bonds, where we specifically focus about comprehensive coverage about the bond market, including government, corporate, municipal bonds, and so on. In loans, basically, we are talking about different analysis of the loan market. Of course, we focus more on news and analysis about this loan market, covering syndicate loans, leverage loan, and private credit. Securitization, we are trying to build a platform, also rather one page for the securitization, where we'll be talking about real-time insights into securitization, structure finance, including MBS, ABS, and CLO, and so on. And highlight to bonds, like we are coming with a municipal bond page, where we'll be just focusing on municipal bonds news, basically about market stories. We'll be talking about success stories about different municipalities, and that page is also live on our website. If you look at our product, basically, as I mentioned, like we cover different market stories. So market stories is nothing but about real-time updates about this product I mentioned, bonds, loans, and securitization. It gives basically insightful news and analysis of the bonds and other products, and we provide in-depth insights into key trends and developments too, that will definitely help you to stay updated about the market. The other product basically we have about the research and analysis, where we take different topics from the debt market. Recently, we published report about corporate bond market review for the FY 24-25. So this kind of basically research report we published fortnightly or monthly on our website. These are basically available on Debt Circle portal. There's another option. There's another product will be coming with, that is league tables. So basically, be providing league tables ranking for the all the market participants, including trustee, registrars, arrangers, and top issuers and rating agencies. That we are working on it, and will be going very live very soon. Also, we have different podcast channel with us. We get in industry, basically, we invite different industry experts from the different product, and they talk about their product and try to give basically insights from the market expert directly to our audience and investors. So you can just go through our website on it's www.deadcircle.in, and you can have a look what kind of products basically we provide. And we are live on LinkedIn, WhatsApp channel, Twitter, and Telegram and Instagram. If you have any questions, you can ping me, or you can just connect me on the LinkedIn. That's all from my side. This is and thank you, Cbonds, for giving me an opportunity to speak here and hosting this webinar as a jointly, basically.
Thank you, Vijendra. Thank you for the structured explanation you gave for the rising retail participation, and for explaining how Debt Circle products may help the retail investors to navigate this rocky ground. So now let's come to discussion. Let me remind our participants, listeners, to leave the questions in the chat. We already get one, but while the listeners are digesting, let me ask a couple of questions for our distinguished speakers. So, Nikhil, I have a question for you. I remember from our live conversation in Mumbai that you are really optimistic about the prospects of retail participation in the Indian debt market. So we should not forget that still the share of retail is very small, even compared with the equity segment. So my question for you is whether the surge in retail participation is on the horizon. Is it coming, or more things need to be done from the regulator side or some other sides to give the ground for this surge in retail participation?
Well, of course, there will be more steps that regulator will have to take, and these OBP platforms are actually playing a very important role in this. So they're actually educating investors. Actually, what is the bond market? What exactly are the NCDs? What is the security that they have? This sort of education is happening on a regular basis. A lot of these platforms, they actually do such webinars, and they actually post a lot of videos on YouTube, wherein investors can learn. The retail investors, the participation has increased, but it can actually significantly increase in coming years. Of course, as I said, the awareness is increasing gradually, and the social medias and the YouTubes of the world are actually helping the retail investors. Initially, few years back, a lot of people were actually not doing equities as well, right? But now any household in India, you can go and see that they are actually doing equities, derivatives, etc. So the time has come for investors to start exploring bond markets, and the all the changes that you are seeing from last 2.5 years have actually increased this awareness. But definitely this will need a lot of push from the regulator as well. But I'm sure these platforms, OBBB platforms, are actually going to change the narrative, and they are actually going to get a lot of retail investors into bond market.
So, if one may say so, the tide has not shifted already, has not changed already, but is changing, and it is like a gradual,
Yes,
iterative process.
yes, it's
Thank you.
still a process. Yes.
Vijendra, I have a question for you as well. So, as the Circle recent corporate bond market review underlines, and I actually advise everyone present to go and check this beautiful research paper by Debt Circle. 95% of corporate bond issues are still private placements.
Yes.
Should we expect larger share of issues to follow the public issue road in the coming years, given activism from the side of retail investors? So, what is your perspective on that?
I think I think it's similar to retail. What's happening on the retail side is similarly that. Of course, like private placement is still 95%. It's going strong, and actually that started from COVID also, because like mostly people have gone privately to come up with the bond issuance. I think, and we expect there is be definitely increase in public issuance as well in coming year, and you must have seen there are a lot of bond issues. You are definitely in the bond market platform. You are providing information about bonds, so you must be seen there are a lot of public issuance is coming uh, uh, in recent days. So I think I will see maybe next year you will see some increase in the public issuance as compared to private placement, but I will still econ on the basically private placement will be the dominant part of the bond issuance.
Thanks a lot. So, Ksenia, now let's go to the Cbonds platform. We have a question in the chat. What is the source of your data? Can you kindly address this question?
Yeah, sure, with a huge pleasure. Well, actually, if we speak about such a difficult market as India, of course, you need to be sure that you get information from a trusted source. So we, as a data aggregator, we collect let's say, the information from primary sources, from stock exchanges, market participants, issuers as well, and provide it on one single platform. So that's also a huge added value for our clients, for our customers, because we, let's say, post this information from different angles, from different, let's say, kind of inputs. And this is how you could, let's say, see the complex view of the market, especially, as you mentioned, the Indian market. Yeah, maybe you can also add something, Max, because as a part of content team, of course, you know more.
Yeah, you actually explained everything quite clearly. We have a lot of inputs, and we sometimes have to eliminate some controversies in data from different sources, clarify things, and yeah, surely this is the source of our added value. Thank you, Ksenia.
Thank you.
So, Vijendra, I also remember that in our conversation you mentioned how investment, for example, in infrastructure bonds, can be supported by sort of sentiment of supporting Indian growth story, like national growth story. And my question is, can ESG related instruments and green bonds attract growing retail or HNI participation due to the same concerns? Are retail investors willing to sort of pay this premium for buying green products?
See, to be honest, like when I study about green bonds and EHE, if you compare the yield as compared to other bonds, so definitely it's going, it's like around coming around 8 to 8.5%. However, if you go to other bonds, it will definitely give more than like around 9% as well. So a retail investor coming to the basically bond market to earn more money, basically, because the FD rates are going down, they're not getting a returns as compared to basically what they expected. So I would still say if retail investor they really want to invest, they might invest in green bonds, but because of the yield factor, they still be more attracted towards the normal bonds. They will take a risk, but of course they will go more towards this one, the normal bond market.
So the same like infrastructure bonds, these instruments are still better suited for institutional demand, right?
Yes, of course, the institutions, not the retail one.
Yes, thank you, Vijendra. And Nikhil, I wanted to know your perspective on the following question. So, the impact of retail investors on the pricing on bonds, on market volatility can be different. It's not uniform. So, from your perspective, increased retail participation in bond trading will bring down the volatility by improving like the liquidity part, or will induce volatility because retail investors are more vulnerable to the market shocks, to the change of sentiment, etc. So, what's your perspective?
So I think this will provide a lot of stability. So we have one example of equity markets. So domestic flows and retail participation in equity markets actually helped India a lot in last 1 year or so, where a lot of FI selling had happened. But the retail participation and the domestic participation has actually given the stability to equity market. So I think it's always good to have retail investors in the system, and this will increase actually the stability a lot, because they are typically not a trader mindset people. They actually invest for a long term period. So I think whenever a retail investor is investing into bond market, it will actually give a lot of infuse in the system liquidity, and I think it is a good sign for the economy if they actually the participation increases.
Thank you for this beautiful explanation, Nikhil. And maybe there are some concluding remarks from our speakers. Nikhil, do you want to add something like concluding the webinar?
Oh, definitely. First of all, thanks for giving me this opportunity. And I think what you guys are doing actually is going to help a lot of retail and HNI participation in our bond market. And overall 2.5 to 3 years of the movement that has happened from different G-Secs to corporate bonds, and the yield movement that has come down has benefited the fixed income market a lot. A lot of investors have made more than double-digit returns in instruments like G-Secs. So it provides a very good opportunity for the retail investors. Indian bond market actually is actually a very stable market. You have seen a lot of rating upgrades in last couple of years. So the way economy is growing, I think there will be more such opportunities that will come, and retail investors and HNI investors can actually participate it on a very on a regular basis.
Thanks a lot for joining, Nikhil.
just feel free to get started your 7-day free trial. We can also, to the audience, we can also organize an individual one-on-one call to discuss what exactly are you looking for, what are your current activities in the fixed income market. And of course, we tend to help everyone whose passion is to track bonds and to invest in this in these markets and others markets as well. Thank you, Max.
Thank you, Ksenia. Vijendra, any remarks?
Thank you, Max. Thanks of all Cbonds and thanks Nikhil providing so insightful session. So as mentioned by him, I completely agree with Nikhil. There is a definite lot of scope for the retail investor. As SEBI is already taking a lot of initiatives and giving a lot of hopes for retail investor. In coming future, I think we'll see mostly retail investor investing in the bond market as compared to other products. And Cbonds and Debt Circle is always there to support investor to study about the bond, about the market. You just follow us and you basically get all kind of information from Cbonds and Debt Circle.
No,
Thanks.
personally, I follow in Debt Circle closely. So,
Thanks, Max.
Wrapping up, I should say that I appreciate a lot our speakers joining us today and sharing their insight. Personally, I learned a lot at our webinar. Thanks to our dear audience as well for your time and attention.